Viewers at home, you are welcome to my presentation on IAS 1, presentation of financial statements. In this presentation, I will provide a further work example using questions from Ezikan May 2021 financial reporting, question number 1, to complement my earlier examples. The following standards were tested in the question I'm going to use as work example. Number 1, you have the IAS 1, which is all about the presentation of financial statements. Number 2, IAS 16, property, plant and equipment. 3, IAS 38, intangible assets. 4, IAS 32, financial instruments, presentation. 5, IAS 12, income tax. 6, IAS 37, provisions, contingent assets and contingent liabilities. Please, if this is your first time of coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be able to receive notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. IAS 1, presentation of financial statements. This question is obtained from Ezikan May 2021, Ezikan May 2021 financial reporting, question number 1, 40 marks questions. The following is the trial balance of Almajiri Nigeria Limited as at September 30, 2018. I will advise you to copy out the question or to try and get a copy of the question so that you'll be able to listen to the explanation for better understanding. The first item is revenue. All figures are in million. Revenue 60,000. Cost of sales 40,800. Distribution cost 2,900. Administrative expenses 4,440. Interest on bank borrowings 40. Research and development cost 1,720. Leasehold property at valuation 1st October 2017, and that is 10,000. Plant and equipment at cost, and that is 15,320. Plant and equipment accumulated depreciation at 1st of October 2017, and that is 4,920. We have capitalized development expenditure. Capitalized development expenditure, that is 4,000. Then we have development expenditure accumulated amortization, and that is 1,200. Closing inventory at 30th of September 2018, and that is 4,000. We have trade receivables, and that is 8,620. Then we have bank 260. We have trade payables and provisions, and that is 4,760. We have preference dividends paid, and that is 160. Dividend paid on ordinary shares 1,200. We have ordinary shares at 25 kobo each, and that is 10,000. Then we have 8% convertible preference shares at 1 naira each, year 2020, and that is 4,000. Then we have retained earnings brought forward, and that is 4,900. Brought forward, BF 4,900. Then we have deferred tax 1,160. Then we have leasehold property revaluation reserve 20,000. The total of both the debit and credit side of the trial balance is 93,200. The following information were extracted from the records of Almajiri Nigeria Limited. We have the additional information. One of the reputable customers of Almajiri Nigeria Limited has sued the company for 400 million naira for breach of contract over a cancelled order. Almajiri Nigeria Limited obtains a legal opinion that there is 20% chance that Almajiri will lose the case. Accordingly, it has provided for 80 million, which represents 20% of 400 million. 20% of 400 million naira, included in administrative expenses in respect of the claim. Unrecoverable legal costs of defending the action are estimated at 20 million, and these have not been provided for as the legal action will not go to court until next year. That is note 1. Note 2. The directors of Almajiri Nigeria Limited have estimated the provision for income tax for the year ended 30 September 2018 at 2,280 million 2280 million naira. The required deferred tax provision at 30 September is 1,200 million. Note 3. The convertible preference shares were issued on 1st of April 2018. 1st of April 2018 at par. They are convertible at a large premium, which gives them an effective finance cost of 12% per annum. Note 4. The leasehold property had a remaining life for 20 years at October 1st, 2017. The company's policy is to revalue its property at each year end, and as at September 30, 2018, it was revalued at 8,600 million naira. That is note 4. Note 5 now. On October 1st, 2017, an item of plant and equipment was disposed of for 500 million naira cash. The proceeds have been treated as revenue by the company. The proceeds has been treated as revenue, by the company. The plant is still included in the company's trial balance. Figure at the cost of 1,600 million naira and accumulated depreciation of 800 million naira, which represent the accumulated depreciation to date of disposal. All plant and equipment are depreciated at 20% per annum using reducing balance method. All plant and equipment are depreciated at 20% per annum using reducing balance method. Depreciation and amortization of all non-current assets are charged to cost of sales. Take note of that. Note 6. In addition to capitalized development expenditure, of 4 billion naira, further research and development costs were incurred on a new project, which commenced on October 1st, 2017. The research stage of the new project lasted until December 31st, 2017 and incurred 280 million naira cost. From that date, the project incurred development cost of 160 million naira per month. On April 1st, 2018, the directors became confident that the project would be successful and yield a profit well in excess of its cost. The project is still in development as at September 30, 2018. Capitalized development expenditure is amortized at 20% per annum using straight line method. All research and development expenditure is charged to cost of sales. You are required to prepare a statement of profit or loss and other comprehensive income for the year ended September 30, 2018. B. Statement of changes in equity for the year ended September 30, 2018. C. Statement of movement in property, plant and equipment to be included in published financial statements. D. Statement of financial position as at September 30, 2018. That is the requirement of the question. This question is obtained from Ezikan May 2, 2021 financial reporting number 1 question, compulsory question, which is 40 marks. Now let's have the solution. Let me start presenting the solution. The requirement A. You are required from the requirement A, you have to prepare statement of profit or loss and other comprehensive income for the year ended September 30, 2018. The name of the entity is Almajiri Nigeria Limited. You have to prepare statement of profit or loss and other comprehensive income. For the year ended September 30, 2018. Remember, the accounting year end is 30th of September 2018. That means this accounting period must have commenced as at October 1st, 2017. If you count from October 1st, 2017 to September 30, 2018, that will be exactly 12 months. That is the accounting period. It runs from October 1st, 2017 and it ends as at 30th of September 2018. Remember, an accounting period is a period, usually 12 months, covered by the financial statement. A period usually 12 months covered by the financial statements. Now all figures are in million. Let me have the notes. The notes to the financial statements. The first item is revenue. You measure your revenue in accordance with IFRS 15. You measure your revenue in accordance with IFRS 15. For better understanding of measurement and recognition of revenue, try to watch all my presentation on IFRS 15. Revenue from contract with customers. Revenue from contract with customers, IFRS number 15. Now, if you go back to the trial balance, you will see a revenue of of 60,000, that is 60 billion. That is the revenue. Then let's go through the notes to the financial statement. Note 5. You were told on October 1st, 2017. October 1st, remember, that is the beginning of this current accounting period. An item of plant and equipment was disposed of for 500 million. Cash. They sell an item of plant and equipment on 1st of October 2017. The proceeds have been treated as revenue. The proceeds have been treated as revenue by the company, which is not ideal. This disposal of property, plant and equipment doesn't occur in the normal course of business. So that means when we say this disposal, if you record it as revenue, that means you have committed error of principles because it has been recorded in the wrong class of accounts. So we are going to remove the 500 million from the revenue given in the trial balance. Remember, the figure of revenue as it is given in the trial balance is 60 billion. So we have 60 billion minus 500 million. That is the proceeds of disposal of property, plant and equipment. So now the revenue figure now will be 59.5 billion. So when you remove the 500 million from the 60 billion, then you'll be left with 59,500,000. That is revenue. After revenue, the next item should be cost of sales. Let me present that in note 1. Let me work it out. Let me have it as note 1. Note 1 will be cost of sales, working 1. That is cost of sales. So cost of sales. Now, you are given cost of sales in trial balance. The cost of sales figure given in trial balance is 40,800. This figure will not be used. It will not be the only cost of sales. That is, some adjustments have to be made to this figure. Let me start with that, 40,800. That is the cost of sales as per the trial balance. Cost of sales as per trial balance. Cost of sales as per trial balance. And that is 40,800. I've told you that the cost of sales that will be used should not be this figure only. Some adjustments have to be made. Now let's go through the notes one after the other to see if there are any if there are a number of items or any item that we need to be adjusted in our cost of sales. The note 1 is one of the reputable customers of Amortization Nigeria Limited has sued the company for 400 million for breach of contract over a cancelled order. Amortization Nigeria Limited obtains a legal opinion that there is 20% chance that Amortization will lose the case. Accordingly, it has provided for 80 million, which represents 20% of 400 million included in administrative expenses. This affects our administrative expenses. It does not affect our cost of sales. So now, let's leave that note 1. Note 2. The directors of Amortization Limited have estimated the provision for income tax. That is income tax provision. It does not affect the cost of sales. That will affect the tax expense. Note 3. The convertible preference shares were issued on April 1st, 2018 at par. They are convertible at a large premium, which gives them an effective finance cost of 12% per annum. This is a financial instrument, so we shall be measured in accordance with IAS 32 financial instrument presentation, and that will affect the liability and the finance cost. So it doesn't affect our cost of sales. Note 4. The leasehold property had a remaining life of 20 years at October 1st, 2017. The company policy is to revalue its property at each year end, and as at September 30, 2018, it was revalued at 8.6 billion. So this is the revaluation. This is the revalued amount. So, and the life will be used to calculate the amortization on the leasehold property. So normally amortization should be charged as an administrative expenses if the company policy does not charge it to cost of sales. Now let's go back to note 5. On October 1st, 2017, an item of plant and equipment was disposed of for 500 million cash. That is the disposal of property, plant and equipment. There is one important accounting concept known as the realization concept. So you recognize profit or loss when an asset is sold or services are provided. Since there is a disposal of an asset, you will need to know if this asset is actually sold at a profit or at a loss. The profits or losses from the disposal of the asset will be recognized or incorporated into our financial statement based on the parent company policy or based on the company policy. Where the company policy is silent, you charge the profit or loss on disposal of an asset to the administrative expenses. But where the policy is to charge it to cost of sales, that means you are going to include it in our cost of sales. So the proceeds have been treated as revenue by the company. We have removed the 500 million from revenue because it has been included therein. The proceeds have been treated as revenue by the company. The plant is still included in the company's trial balance figure at the cost of 1.6 million. It should be 1.6 billion now, since there is million here. An accumulated depreciation of 800 million to date of disposal. All plant and equipment are depreciated at 20% per annum using reducing balance method. Depreciation and amortization of all non-current assets are charged to cost of sales. So you see the policy now. Depreciation and amortization of all non-current assets are charged to cost of sales. Since the depreciation and amortizations are to be charged to cost of sales, then that means we will need to comply with the policy of the company. You are going to charge the amortization and the depreciation to cost of sales, not administrative expenses, because the policy is to charge them to cost of sales. But remember the method of depreciation used for plant and equipment, which is reducing balance method. Under reducing balance method, depreciation is calculated on the carrying amount of an asset. By carrying amount, we mean the net book value of the asset. To arrive at the carrying amount or the net book value, you have the cost less accumulated depreciation to date. That will give you the carrying amount. Then you now calculate your depreciation. You apply 20% on that carrying amount to arrive at the depreciation charge for the year. Take note of that. Since the company policy is to charge depreciation and amortization of all non-current assets to cost of sales, now let's calculate the amortization of leasehold property. The leasehold property had a remaining life of 20 years. Now that means you will need to calculate the amortization of the leasehold premises at 1st October 2017. Remember, 1st October 2017 is the beginning of this current accounting period. And the accounting year end is September 30, 2018. And that means the accounting period has commenced as at October 1st, 2017. And this means this leasehold premises, this is the first year of the life of the leasehold premises. You are going to amortize it over 20 years. Now, let's calculate the amortization of the leasehold premises. Amortization of the leasehold premises. Now, how much is the cost of the leasehold premises? Leasehold property at valuation. The valued amount as at the beginning of the period, which is 1st October 2017, is 10,000. Now, let's calculate the amortization of the leasehold premises now. Amortization of the leasehold leasehold property. The valuation, the valuation, that is the valuation of the leasehold property is 10,000. 10,000, and you want to amortize it over 20 years, so that means you divide it by 20. Then the amortization charge for the year will be 500 million. 500 million. Then note 5. Having calculated the amortization of the leasehold premises to be charged for the year, then let's consider note 5. On October 1st, 2017, which is also the beginning of the current accounting period, an item of plant and equipment was disposed of for 500 million cash. There is a disposal of plant and equipment. I've told you that based on the realization concept, you have to calculate the profit or loss on disposal of plant and equipment to be included in cost of sales. I've told you that the profit or loss from disposal will need to be included in cost of sales, since the depreciation policy of that asset is also on the cost of sales. Now, the proceeds have been treated as revenue by the company. The plant is still included in the company's trial balance figure at the cost of 1.6 billion naira. The cost of that plant and equipment is 1.6. Then an accumulated depreciation of 800 million to date of disposal. All plant and equipment are depreciated at 20% per annum. Let's calculate profit or loss from the disposal of plant and equipment. Disposal of plant and equipment. The carrying amount is 1/6 less the depreciation. You are given the accumulated depreciation to the date of disposal to be 800 million, and the carrying amount is 1/6. Then that means the carrying amount, the cost is 1/6 less depreciation to the date of disposal. That means the carrying amount will be 800 million. If the carrying amount of the plant and equipment is 800, and the proceed is 500 million as it is given, the carrying amount exceeds the proceed. That means the plant and equipment is sold at a loss. Then you arrive at the loss from disposal of plant and equipment, which is 800 minus 500, and that will give us 300 million. Where the proceeds exceed the carrying amount, that means it's a profit. If it is profit, you are going to subtract. But since the carrying amount exceeds the proceed, then that means it was disposed at a loss. Then you are going to add the loss to cost of sales. I've told you that if it is profit, you subtract the profit from cost of sales. We are charging it to cost of sales because the depreciation policy is on cost of sales. Then let's calculate depreciation. Now. Let's calculate depreciation on the first asset. Then we have plant and equipment as well. Plant and equipment. Remember, the method of depreciation used is reducing balance method, because you have been told in the question that the plant and equipment, that is plant and all plants and equipment are depreciated at 20% per annum using reducing balance method. The method of depreciation is reducing balance method. I've told you that under reducing balance method, depreciation will be calculated on the carrying amount. Now, to get the carrying amount, you have the cost. Cost less accumulated depreciation. But the cost now, the cost of plant and equipment is how much? Then you go through the trial balance to find out the cost. The cost of the plant and equipment. Plant and equipment at cost 15,320. That is the cost. The cost is 15,320. Remember, you were told that the cost of the plant and equipment disposed is still included in that. The plant, you were told that in note 5 that on October 1st, 2017, an item of plant and equipment was disposed of for 500 million cash. The proceeds have been treated as revenue by the company. The plant is still included in the company's trial balance figure at the cost of 1.6 million, which is 1.6 billion. This cost is still included in the cost given in the trial balance. So, and since that is included, you will need to remove the one disposed minus 1.6, because that is no longer part of the plant you have. Then if you remove that, then you'll be left with, now let me depress the calculator, 15,320 minus 1.6. Then that means the plant and equipment you are left with is 13,720. That is the one that are still remaining. That is the one that have not been sold. Remember, the method of depreciation to use is reducing balance method. So since it is reducing balance method, I've told you that the accumulated depreciation have to be removed in order to arrive at the carrying amount. Now, how much is the accumulated depreciation figure given in the trial balance? The accumulated depreciation, plant and equipment, accumulated depreciation 4,920. You have to remove that 4,920. Accumulated depreciation, which is 4,920. Then the depreciation in the accumulated depreciation on the plant and equipment disposed is still included in that 4,920. So you have to remove that. So this 1.6 million, an accumulated depreciation of 800 million to date of disposal, that is still included in that depreciation also. So now let's remove that accumulated depreciation. So we have minus 800. So you have 4,920 minus 800. Then you'll be left with 4,120. If you remove the accumulated depreciation of 4,120 from 13,720, then you'll be left with the carrying amount of 9,600. That is the carrying amount of the plant and equipment remaining, which is 9,600. Remember, you are doing all this because the method of depreciation is reducing balance method. Now, how much will be the depreciation that will be charged on that plant and equipment now for the year? So your depreciation now, depreciation to be charged on plant and equipment, remember you were told that you should depreciate it by 20% on reducing balance. So you have 20% of 9.6. So there you have depreciation of 1,920. That is the depreciation on plant and equipment. In note 5, you were told that in addition to capitalized development expenditure of 4 billion naira, in your trial balance, you are given the capitalized development expenditure of 4 billion in trial balance. Capitalized development expenditure of 4 billion. That is the one they were referring to. And that one equally has an amortization of 1.2. So 1.2 billion. So they are referring to that 4 billion. That is why they say in addition to capitalized development expenditure of 4 billion, further research and development costs were incurred on a new project which commenced on October 1st, 2017. That new project commenced at the beginning of the accounting period. The research stage of the new project lasted until December 31st, 2017. The research stage lasted until December 31st. Remember, you were told that the project commenced on 1st of October 2017, and the research stage lasted from that October to December of the same year, 2017. Now, if you count, how many months is that? October, November, and December. That is 3 months. The research stage first is just 3 months. You were told, in accordance with IAS 38, intangible asset, the life of the project were broken down into two. The research stage of the project life, or the first, let me call it the project phase, was divided into two: the research phase and the development phase. At the research phase of the project, it is not yet highly probable that this project will be successful and yield a positive cash inflows in the future. So since it is not probable that the project will be successful at the research stage of the project, all expenditure incurred on the research phase of the project should be expensed. All research expenditure, you don't just bother about that, just charge that as an expenses. And incur 280 million. That means the 280 million was incurred on research. Then remember, the research stage is just 3 months out of 12 months since the project commenced as at October. Out of 12 months, October 2017, to know the accounting year end is September 2018. 3 months is the research phase. That means the remaining 9 months will be the development phase. So, and incur 280 million. This 280 million was incurred on the research phase. From that date, the project incurred development cost of 160 million per month. 160 million. 160 million per month. Remember, the development phase will be 9 months now. That is why I have 160 times 9. That gives us 1,440. If you add the 280 plus 280 that was incurred in the research phase of the project, then you have 1,720. 1,720. That is the research and development expenditure. If you go through your trial balance, you will see the 1,720 there. The research and development expenditure. Research and development cost. You have 1,720. That it is this 1,720 they are referring to. I've told you that the research phase 280 plus the development phase 160 per month. 160 times 9, which gives us 1,440 plus 280. That is what gives us this. So that is research and development expenditure. Out of this, we said those one incurred at the research phase of the project have to be expensed, and which is of course 280 million. 280 million. Now let's have the research expenditure. Research expenditure of 280 million, that will be expensed. 280 million. Now, the next one is the development expenditure. The development expenditure. You were told that on April 1st, 2018, the director became confident that the project would be successful. That means the time, we said the research phase lasted until December 31st, 2017. That means the development phase will commence as at January 1st, 2018. But before the director became confident that the project will be successful is April 1st. That means as at January 2018, February 2018, and March 2018, the director is not yet confident that this project will be successful. So now the development phase of the project will be divided into two, which I call the certainty phase and uncertainty phase. The development phase will be divided into two. One, the certainty phase of the project, And 2, the uncertainty phase of the project. And the uncertainty phase is the phase where the director is not yet sure that the project will be successful and yield positive cash inflows. But the certainty phase is when the director is very confident, when the director becomes confident, when the director is very sure that the project will be successful and yield positive cash flows in the future. That is certainty. I repeat, uncertainty phase is the development phase where the director is not yet very sure that the project will be successful. But the certainty is when the director became confident that it will be successful. The development expenditure incur as at the phase of the project when the director is not sure that the project will be successful should be expensed. That means the development expenditure incurred in the uncertainty phase of the project should be expensed, while the one incurred in the certainty phase should be capitalized. Please bear that in mind. Now, that means the development expenditure incurred in January, February, and March 2018, when the director is yet to become confident that the project will be successful, that won't have to be expensed. Now, let's calculate the development expenditure that will be expensed. So, development expenditure. Development expenditure, the one incurred in the uncertainty phase, which is development expenditure is 160 million per month, and the uncertainty phase is January, February, March, which is 3 months. So we have 160 million times 3, then we have 480 million. That will also be expensed. But why am I charging the development expenditure to cost of sales? Why not administrative expenses? You have been told in that note that the project is still in development as of September 30, 2018. Since the project is still in development, that means you don't need to amortize. You don't need to calculate the amortization on the development expenditure incurred during that year. So, capitalized development expenditure is amortized at 20% per annum using straight line method. All research and development expenditure is charged to cost of sales. You have been told all research and development expenditure, you have to charge them to cost of sales. That is the reason for my charging that to cost of sales. So not administrative expenses. So the one incur from April 1st to September, if you can't, April, May, June, July, August, and September, that is 6 months. That one will be capitalized. To capitalize it, it means to record it as an asset. You don't need to amortize it because that project is still in development. As at September 30, that project have not been completed. You only amortize that where the project has been completed. So the one that will be amortized now is the 4 billion which has been capitalized from the inception, which has been capitalized before, where you are given capitalized development expenditure, which is 4 billion. This one will need to be amortized. Now let's calculate the amortization on development expenditure. Amortization of capitalized development expenditure, which is 4 billion, and you have to use 20%. Straight line is to be amortized. You were told that capitalized development expenditure is amortized at 20%. So you have to amortize it using 20%. Now, 20% of that. 20% of 4 billion. Then we have 800 million. So that is the amortization of the development expenditure. Please take note of that. Now, having calculated that, and we've considered all necessary details to be adjusted in our cost of sales, then you may then sum up your cost of sales now. Now let's cast. That cast is 4,800 plus, we are given 4,800 plus 500 plus 300 plus 1,920 plus 280 plus 480 and plus 800. The total is 45,080. 45,080. That is the amount that will be included in cost of sales for the period. 45,080. 45,080. That is our cost of sales. So 45,080. When you subtract cost of sales from revenue, then you arrive at the gross profit. Gross profit. Our gross profit is revenue less cost of sales, which is 14,420. 14,420. 4420. After cost of sales, after gross profit, then you have distribution cost, which is 2,900. We don't have any adjustment that affects our distribution cost. So distribution cost, that is 2,900. Then after that, we have administrative expenses. Let's have that as note 2, because we have a note on that. Note 2, that is administrative expenses. Administrative Then you have the administrative expenses as per trial balance. The amount given in the trial balance, you start with that. Admin expenses as per trial balance. How much is given as an administrative expenses in trial balance? You are given the administrative expenses in trial balance to be 4,440. 4,440. 4,440. Then if you go back to the note, in note 1, you were told that one of the reputable customers of Almajiri Nigeria Limited has sued the company for 400 million for breach of contract over a cancelled order. Almajiri Nigeria Limited obtains a legal opinion that there is 20% chance that Almajiri will lose the case. Accordingly, it has provided for 80 million, which represents 20% of 400 million included in administrative expenses in respect of the claim. This 80 million has been included in administrative expenses for that claim. The unrecoverable legal action will not go to court until next year. Please take note of that note. The legal action, you were told it will not go to court until next year. Since it has been stated in the note 1 that the legal action will not go to court until next year, and the action against Almajiri Nigeria Limited is unlikely to succeed because the probability of the success outcome is just 20%. That 20% chance is too infinitesimal. So that since it is too infinitesimal, that means it is unlikely to be successful. The potential damage is a contingent liability of 400 million naira. That damage is a contingent liability which depends upon the happening of that uncertainty, which can only to be disclosed by the way of note. Which can only be disclosed. We used to disclose the contingent liability by the way of notes to the financial statements. We don't used to recognize it, only disclose it in the note in accordance with IAS 37. So in accordance with 37, contingent liability should be disclosed in the note. It should not be included in the financial statement. Meaning that the 80 million which have been included in administrative expenses have to be recognized. That is, you have to remove it from the financial statement. That means you will need to remove the 80 million from the administrative expenses because it doesn't qualify, it doesn't meet the recognition criteria. So it is a contingent liability. The unrecoverable legal cost is a liability and should be provided for in full. The legal cost of 20 million, that one have to be recognized. So now you have to remove the 80 million which have been included in administrative expenses, then and recognize the 20 million. So we have in our administrative expenses, we have provisions for court claims which have been made before provision for court claims of 80 million which have been recognized. So you remove it. Then you are now making provisions for unrecoverable legal costs of 20 million. You have to recognize that. So now, after you cast it, 4440 minus 80 plus 20, you have 4,380. 4,380. Now, our administrative expenses now to recognize will be 4,380. 4,380. After administrative expenses, the next item is finance cost. I've told you that finance costs are interest-related items. Let me have that as note 3. Finance costs are interest-related items. Anything relating to interest. So now, note 3, you have finance cost. Now, let's go through the trial balance. What are items of interest you have in the trial balance? So we recognize as finance cost. So, now, in our trial balance, we have interest on bank borrowings, 40 million. Interest on bank borrowings, which is 40 million. Interest on bank borrowing of 40 million. Then aside this, in the note 3, you were told that the convertible preference shares were issued on April 1st, 2018. This is the issue date. That means at the beginning of the year. It was issued during the year, not at the beginning. It was issued during the year. If you count from April 1st, 2018 to the end of the year, which is September 30, how many months is that? We have April, May, June, July, August, that is 5 months, September, September, that is 6 months. April, May, June, July, August, that is 5 months. Then September, 6 months. That means from the date of issue of the preference shares to the end of the reporting period is just a period of 6 months. In accordance with IAS 32, financial instruments, convertible preference shares is a debt instrument. It's not an equity instrument. So the dividend due to the convertible preference shares should be recognized as a finance cost, and that is why they even use effective finance cost here. So it is a finance cost. So you calculate 12% of that preference shares, the convertible preference shares. How much is the convertible preference shares given in the trial balance? Remember, the coupon rate is 8%. You were told that it has been increased. The effective interest is 12%. So 8% convertible preference shares of £1 each year 2020. That is the date of the redemption. It will be redeemed in 2020. So, and that is 4,000. So, any redeemable preference shares is a debt instrument. So 12% of 4,000, that will be the final cost, the preference shares dividend now. Preference shares dividend. So our finance costs now include the preference shares dividend. Preference shares dividend, which is 12% of 4,000. Then for 6 months from the date of EU, which is 6 months, 12% of 4,000. Then for 6 months from April 1st to September 30, which is 6 months, and that will give us 240. If you add the 240 to the 14 above, then you have 280. That means our finance cost will be 280. Now you include that in our statement of profit or loss. Our finance cost is 280. So you less the distribution cost of 29 and administrative expenses of 4,380 and finance cost of 280 from the gross profit. Then you arrive at the profit before tax. Profit before tax. Now the net difference now is 6,860. 6,680. That is our profit. 6,860. Sorry. 6,860. That is our profit before tax. 6,860. Then the next thing should be income tax expense. Income tax expense. Let me have that to be note 4. Note 4. We have income tax expense. That is note 4. Then the measurement of income tax is covered in IAS 12, income tax. Now, to measure your tax, you start with the provision for tax for the year, then after which you consider the over provisions and the under provision. Then how much is your provision for income tax for the year? Now, that is what we are going to check out. Note 2. The directors of Almajiri Nigeria Limited have estimated the provision for income tax for the year ended 30 September 2018 at 2,280,000,000. That is the provision for income tax for the year. Then the required deferred tax provisions at started September is 1.2 billion. Now you start with the provision for income tax for the year, which is 2280. Provision for income tax for the year. Provision for income tax for the year, and which is 2280. Then the deferred tax you are given. It is the movement in deferred tax that we need to be adjusted in the tax to be charged as an expenses in the statement of profit or loss, not the actual deferred tax. It is the actual deferred tax at the end of the year of 1.2 million that should be recognized as non-current liability in the statement of financial position. The actual of 1.2 million is what we are going to recognize in the statement of profit or loss. I mean in the statement of financial position. The actual deferred tax of 1.2 billion is what we are going to recognize in the statement of financial position as non-current liability. While the provision for income tax for the year, you are going to recognize that as tax in the current liability. This one will appear as current liability, while this will appear as non-current liability. But the tax to the deferred tax to adjust now is the movement in deferred tax. Now to get the movement, the actual deferred tax at the end of the year is 1.2. How much is the deferred tax you have at the beginning of the year? Now go through your trial balance. You see deferred tax. Deferred tax 1160. That is the opening balance. Deferred tax is 1,160. While the closing balance is 1,200. That is deferred tax. Deferred tax 1,200. That means it has increased from 1,160 to 1,200. It is the increase. Anytime there is an increase in deferred tax, you add the increase. While decrease in deferred tax, you'll be subtracted. So now, increase in deferred tax. It is an increase because the closing, which is 12, is more than the opening of 1160. Increase of 40. Increase of 40. If you add the 40 to 2,280, then you have 2,320. 2,320. This 2,320 is the amount of tax that will be expensed in the statement of profit or loss. So 2,320. If this is expense, you subtract 2,320 from the profit before tax of 6,860. Then you arrive at the profit for the year. Profit for the year of 4,540. 4,540. After profit for the year, the next item to deal with is the item of other comprehensive income. Then the next item should be other comprehensive income. Other comprehensive income. The only item of other comprehensive income we have is the revaluation which was made on leasehold property. Now you want to know if this leasehold properties was revalued, whether there is a revaluation gain or revaluation deficit. Now let's calculate gain or loss on property revaluation. Gain or loss on property revaluation. Now, remember the cost of the property, that is the leasehold property. If you look at note 4, that is why you have information about the revaluation of that leasehold property. The leasehold property had a remaining life for 20 years at October 1st, 2017. The company's policy is to revalue its properties at each year end. And as at September 30, 2018, it was revalued at 8.6 billion. So we have the revalued amount to be 8.6 billion. How much is the opening balance of leasehold property? The leasehold property opening balance, leasehold property is 10,000. Now revalued to 8.6. So we have the valuation balance brought forward. That is the valuation, the opening balance, which is 10,000. 10,000. Remember, you were told in that same note 4 that is to be amortized over 20 years. That means you have the amortization. That is the 10,000 divided by 20, the amortization of 500. Now, the value ought to be, the carrying amount now is, the carrying amount is 95. Now revalued to 86. Revalued to 8,600. Now, this means that the value has now fell from 95 to 86. 9,500 minus 8,600. The value fell to 86. That means it has fell by 900. That is revaluation deficit. If it is gain, it will be negative. That means this will be more than this. Then you have minus this. But it is a deficit. That is why the carrying amount exceeds this. Actually, that is why I bracket gain. It will be a gain when it is negative. So we will have revaluation deficit of 900. This fair value deficit now, revaluation deficit now will now be included in other comprehensive income deficit. That is note 5. And have this as note 5. 900. If you now subtract 900 from 4,540, then you'll be left with 3,640. I'm subtracting it because this is a deficit, and this will now be total comprehensive income for the year. Total comprehensive income for the year, which is 3,640. 3,640. Then that is the requirement A. We've done with that. Then the next one is requirement B. So requirement B, you have to prepare a statement of changes in equity for the year ended September 30, 2018. That is requirement B. Statement of changes in equity. So that is the next requirement. Statement of changes in equity. Now, the name of the entity is Almajiri Nigeria Limited. You want to prepare the statement of changes in equity for the year ended September 30, 2018. So that is the next thing. Statement of changes in equity for the year ended September 30, 2018. Then you identify the equity component in the question. What are the equity components? Let's go through the trial balance. What are the equity components we have in the question? Now go through the trial balance one after the other. So you have the ordinary shares. We have ordinary shares, which is 1. Then we have retained earnings, that is 2. We have leasehold property revaluation reserves, that is 3. Those are the 3 components of equity. Now let's create those 3 columns. In addition to that, let's have total. So the equity, it comprises, let's have 4 columns. The fourth column will be total. 2, 3, 4. The first column is ordinary share. Ordinary shares. The second column is retained earnings. The third column is the revaluation reserve. Revaluation reserve. And the third column, the fourth column is total. Now, million, then you start with the opening balance, which is balance brought forward. The opening balance is the balance you are given in the trial balance. The opening balance will be found in the trial balance. Then that of ordinary shares is 10,000. 10,000 for ordinary shares. Retained earnings is 4,900. And revaluation reserves of 2,000. 10,000, 4,000, and 2,000. So that is for that. 10,000 for ordinary shares. Then retained earnings of 4,900 and 2,000 for revaluation reserves. Then you sum it up. The total will be 16,900. In that same trial balance, you have the dividend paid to ordinary shares. Remember, the preference dividend is a finance cost. Then dividend paid on ordinary shares is 1,200. Dividend paid. Dividend paid. Dividend paid on ordinary shares. Paid. Dividend will be paid out of retained earnings. So you remove it from the retained earnings. That is why I put it in bracket. I jacket it. I put it in braces, in bracket. Then, from the statement of profit or loss, another comprehensive income we have prepared. You will have the total comprehensive income for the year. Total comprehensive income for the year. Now, this total comprehensive income is divided into two components. There are two components there. The first component is profit for the year, 4,540. And the other one is revaluation deficit of 900. So those two balances, 4,540 and 900, we have to move to statement of changes in equity. Profit for the year is 4,540. That will be included in the retained earnings section of the statement of changes in equity. And the revaluation reserves, we have revaluation deficit, that will go to revaluation reserves. Then the total, that is 4,540 minus 900, the total is 3,640. Then you balance it. You balance your statement of changes in equity. So we have balance as at September 30, 2018. Here you have 10,000 ordinary shares column. Then the retained earnings, you have 4,900 minus 1,200 plus 4,540. You have 8,240. Then 2,000 minus 900 will be 1,100. Then the total, you have 16,900 minus 1,200 plus 3,640. You have 19,340. 19,340. That is all about the statement of changes in equity. Having prepared the statement of changes in equity, then the next requirement is C. In the C part of the question, you are to prepare the statement of movement in property, plant, and equipment. Statement of movement in property, plant, and equipment. That is the requirement C. The requirement C, statement of movement in property, plant, and equipment to be included in published financial statements. That is the requirement C. The requirement C now. You have statement, that is for Imagine. Statement of movement in property, plant, and equipment to be included in the published financial statements. Now, then you prepare this in accordance with IAS 16, property, plant, and equipment. The only assets that can be included in property, plant, and equipment are the leasehold property and plant and equipment. Those ones we have in this question. So now let me create 3 columns. Then the first one for leasehold property, then we have plant and equipment, then total. The first one, you start with the opening balance. Balance brought forward, which can either be cost or valuation. Now let's go through the trial balance. How much is the cost of the, then we have the leasehold properties at valuation 10,000. Then we have plant and equipment at cost 15,320. Now we start with that. Leasehold property at valuation 10,000. And then the other one is plant and equipment is 15,320. The total will be 25,320. There is no acquisition of property, no acquisition of an asset. But we have disposal. Disposal. The word disposal means sales. Plant and equipment were disposed. The only one that was disposed is the plant and equipment. The proceed was 500 million and the cost was 1.6 million. So the cost 1.6 million or 1.6 billion. Disposal 1.6. 1.6. Then we have revaluation. But we have revaluation deficit as calculated the other time. The asset that was revalued is the leasehold property, and that we had a deficit of 900. So, because it is deficit, that is why I'm subtracting that. Now, you cast it. You sum it up. When you add, this one will be 9,100. That of plant and equipment will be 13,000. If you have 15,320 minus 1.6, that will be 13,720. Then the total column, 25,320 minus 1,600 minus 900, you have 22,820. 22,820. That is the balance at 30th September 2018. After that, then you have the depreciation. Depreciation. You start with the opening balance of depreciation as well. Balance brought forward. Depreciation stroke amortization. So, in terms of, if you go through your trial balance, in your trial balance, we have depreciation of plant and equipment, accumulated depreciation. Plant and equipment, accumulated depreciation 4,920. But since leasehold property is just occurring for the first time, that has no amortization previously. So we have balance brought forward here. That of leasehold property is nil, but you have 4,920. 4,920. Then charge for the year. Charge for the year. You go back to our workings of cost of sales, where we calculated our cost of sales. That is working one. From our working one, remember your leasehold is to be amortized over 20 years. And when we divided the 10,000 by 20 years, we got 500. Then that of plant and equipment, go back to the workings of cost of sales. You know, we had, when we calculated depreciation on the carrying amount of 9,600, we got 1,920. So when you add the 500 and 1,920, you have 2,420. These two figures will be obtained from our workings on cost of sales. Then we have disposal. An asset that was disposed. How much is the accumulated depreciation on that asset? That is obtained in note 5. From our note 5, you were given the depreciation, accumulated depreciation of 800 million attributed to asset disposed. So you have 800 million disposal. 800. Now, how much is the total your accumulated depreciation to date? This one will be 500. Accumulated depreciation as at September 30, 2018. This one is 500. Then we have 4,920 plus 1,920 minus 800. You have 6,040. 6,040. Then this one for the total 4,920 plus 2,420 minus 800. You have 6,540. 6,540. Then the next thing is the carrying amount. Carrying amount. You calculate the carrying amount as at the beginning of the accounting period, which is 1st of October 2017, and the one as at September 30, 2018. The beginning of the accounting period and the end of the accounting period. To get the one at the beginning, you take the balance brought forward here minus the balance brought forward here. 10,000 minus nil. This one will still be 10,000. To get the one as at the end of the period, you take the closing balance here minus the closing balance. 9,100 minus 500. Then you have 8,600, which bounce back to the revalued amount. You know, this asset was revalued to 8,600. Then for the plant and equipment, the opening balance is 15,320. minus the opening balance of 4,920. Then you have 10,400. That will be the carrying amount as at the beginning of the period. Then for the closing, 13,720 minus 6,040. Then you have the 7,680 as the carrying amount as at the end of the period. Then for the total, 25,320 minus 4,920. Then you have 20,400. 20,400. For the closing, 22,820 minus 6,540. Then you have 16,280. 16,280. That is the requirement C. Having done with the requirement C, then the next one is the requirement D, where you are to prepare the statement of financial position as at September 30, 2018. Then requirement D, you are to prepare the statement of financial position as at September 30, 2018. Now, let's have that. Then the name of the entity is Almajiri Nigeria Limited. Almajiri Nigeria Limited. You want to prepare statement of financial position as at September 30, 2018. So the first thing should be assets. The first asset, we are going to have non-current assets. As part of our non-current assets, you have the property, plant, and equipment. And that has been obtained from the requirement C. Property, plant, and equipment. That is obtained from the requirement C. And in requirement C, you have obtained the carrying amount, the total carrying amount of all the property, plant, and equipment to be 16,280. 16,280. 16,280. 16,280. After that, we also have the development cost, capitalized development cost. Let's have that as note 6. Note 6, development cost. How much is our development cost as per the trial balance? The one that was capitalized. That means the capitalization criteria. You were told that capitalized development expenditure, and that is 4,000. So that is the first one. Balance brought forward. Balance brought forward. The one capitalized. Which is 4,000. That has been capitalized in the prior period. But those ones that were incurred during the year, how many of it meets the capitalization criteria? you were told that in addition to the capitalized development expenditure of 4 million, that is the one we have brought forward, further research and development costs were incurred on a new project which commenced on October 1st, 2017. It commenced as at the beginning of the accounting period. The research stage of the new project lasted until December 31st, 2017. So that means we have expensed all the research expenditure. So we don't need that. And incur 280 million. We don't need the 280 million for any longer. From that date, the project incurred development cost of 160 million per month. The 160 million incurred on development as development expenditure is what we are concerned with. On April 1st, 2018, the directors became confident that the project will be successful. We said the development expenditure incurred from the date, the certainty stage or certainty phase of the project, which commences at April 1st, 2018. That one will be capitalized. That means we want to capitalize the development expenditure for April, May, June, July, August. That is 5 months. Then September, making 6 months. So 6 months times 160, that is what we are going to capitalize. That is the one that meets the capitalization criteria. Then you were also told the project is still in development as of September 30, 2018. Since it is still in development, that means you don't need to amortize it. So the one that meets the capitalization criteria now will be, then we have development expenditure capitalized during the year. You know, the development expenditure is 160 million per month. We said 6 months of it will be capitalized. 160 million times 6, that will give us 960 million. It is the 960 million that meets the capitalization criteria. We said this 960 million will not be amortized because the project is still in development. So this 4,000 will be amortized. Now we have amortization of development expenditure. Balance brought forward. The balance brought forward, how much is the amortization that have been charged in the prior period? If there is amortization charge in the prior period, that will be given in the trial balance. So we have that. We have capitalized development expenditure. Development expenditure, accumulated amortization, 1/10/2017, and that is 1,200. So that is the amortization in the prior period, 1,200. 1,200. Then the amortization charge for the year. Charge for the year. How much is the amortization that will be charged for the year? Now, you were told in the note that the amortization is to be amortized at 20%. Capitalized development expenditure. You were told that the capitalized development expenditure is amortized at 20% per annum using straight line. So 20%, since it is straight line, so you have 20% of the cost. The cost of 4,000, you know, that has been charged in our cost of sales. That, and we got 800. So you see the 800 in your cost of sales, working one. Then 2 plus 800, you have 2,000. Why are we not charging amortization on 960? I've told you that because the project is still in development. That is why you don't need to charge amortization on the 960. Had it been the project had been completed, then you will need to amortize the 960 at 20%. So 4,000 plus 960 minus 2,000. Then you have 2,960. 2,960. So that is the development expenditure that will be recognized. That is in the statement of financial position. 2,960. So when you sum it up, you get the total of our non-current asset. Total non-current asset. Total non-current assets. Our non-current asset is totaled 19,240. 19,240. That is 16,280 plus 2,960. That is 19,240. After non-current assets, the next thing should be current assets. Current assets. You go through your trial balance. What are the non-current assets and what are the current assets we have in our trial balance? So, in the trial balance, the current assets items we have include closing inventory 4,000, closing inventory 4,000, trade receivables 8,620. But I want you to know that the bank here is at the credit side of the trial balance. That's to show that since it is at the credit side, it shows that it is a bank overdraft, not current asset. This is bank overdraft. That is why it has been included at the credit side of the trial balance. But if it is at the debit side, then you can record it as current asset. So the two current assets we have are the closing inventory and the receivables. So closing inventories and the receivables. Now let's have that. Closing inventories, that amounted to, the closing inventory is 4,000, and this is obtained from the trial balance. $4,000. Then we have receivables in trial balance. Our receivables in trial balance is given to be 8,620. 8,620. These are the two current assets we have. So when you add that, you have the total current assets. Total current assets. And that amounted to, if you have 4,000 plus 8,620, then you have 12,620. 12,620. If you add 12,620 to the non-current assets we have, which is 19,240, then you have the total assets. Total assets. Our total assets will be 31,860. 31,860. That is the total assets. After total assets, the next section is the equity and liability section of the statement of financial position. Then we now start with the equity section. The balance to be used will all be obtained from our statement of changes in equity. Remember, we have three elements there. The three elements we have in our statement of changes in equity is: number one, ordinary shares; number two, retained earnings; number three, revaluation reserves. So now let's have them. The first one, ordinary shares. Ordinary shares. ordinary shares. The second one is retained earnings. And the third one is reserves. Or let me say revaluation reserves. Now, the ordinary shares in the statement of changes in equity is 10,000. While retained earnings is 8,240. Now let's include that. Ordinary shares 10,000. 10,000. Retained earnings is 8,240. 8,240. Then the third one is revaluation reserves. The revaluation reserves is 1,100. 1,100. That is the revaluation reserves. 1,100. So now when you sum up that 10,000 plus 8,240 plus 1,100, the total will be 19,340. That is the total equity. Total equity. After the total equity, the next one will be the non-current liabilities. The non-current liabilities. Non-current non-current liabilities. Now, remember we have the 8% convertible preferences. 8% convertible preferences. Let me have that as note 7. Note 7. Preference shares. Note 7. Then my note 7 now. Note 7. We have 8% convertible preference shares. You start with the opening balance. That is the amount of preference shares given in the trial balance. You are given 8% convertible preference shares of £1 each. That is of 4,000. That will be the opening balance. Opening balance is 4,000. Balance brought forward, and that is 4,000. Then the finance cost we have included in our interest, that is finance cost, we've calculated the other time. 12% of 4 million, that is in accordance, that is, we have that information in note 3. The finance cost we have calculated, that is from note 3, where you have 8% convertible preference shares were issued on 1st of April, 1st of April to September 30, 2018, that is 6 months. At par, they are convertible at a low premium, which gives them an effective finance cost of 12%. So where we calculated that finance cost of 12%, finance cost of 12%, 12% of 4 million for 6 months, that is from April to September, and we got 240. So, and that is to be added. Then we also have preference dividend paid, and that is given in the trial balance. Preference dividend paid. This is given in the trial balance, representing dividend paid for 6 months. Preference dividend paid. Preference dividend paid 160. You subtract that minus the 160 paid. So 160. Then you have 4,080. 4,080. Then that is the convertible preference shares to be recognized as non-current liability, which is 4,080. Then after that, we have deferred tax. Deferred tax. $4,080. So this was in note 7. Then we have deferred tax. The actual deferred tax of 1,200 given in the note. The actual deferred tax of 1,200 given in the note 2. Note 2. The directors of Almajiri Nigeria Limited have estimated the provisions for income tax for the year ended September 30, 2018 at 2,280 million. The required deferred tax provisions at 30 September is 1,200. So it is that 1,200 are recognized as non-current liability. After that, I think those are the two non-current liabilities we have. So you may sum them up. The total of our non-current liability, the non-current liability totaled 5,280. 5,280. After non-current liability, the next section of the statement of financial position will be the current liabilities. Current liabilities. Our current liabilities include trade payables and provisions. Trade payables and provisions, 4,760. Now, we have a note on that. Remember the provision which have been made earlier of 80 million. We said it doesn't qualify the criteria for recognition as liability, that it should only be disclosed by the way of note. And since that have been included in the trade payables and provisions of 4,760, we have to remove that. We remove it from 4,760, and the 20 million which represent the unrecoverable legal cost. So this one will be added. So note, let me have that as note 8. Note 8. Note 8. Let that be trade payables and provisions. Balance brought forward. The 4,760 given in the trial balance. 4,760 given in the trial balance. Then from that figure, you deduct provision for court claims. Provision for court claims which have been included, which doesn't qualify for recognition because it is a contingent liability. So we remove that 80. Then we also add unrecoverable legal claim. Unrecoverable legal claim of 20 million. So 4,760 minus 80 plus 20, and that will give us 4,700. 4,700. That is note 7. 4,700. So we have trade payables and provisions, trade payables and provisions. That is note 8, and that is 4,700. We have bank overdraft of 260 to be recognized as current liability. Bank overdraft, and that is 260. Then we also have the provision for income tax for the year, which is 2280. Provision for income tax for the year, and that is 2280. You now sum up the current liability, 4,700 plus 260 plus 2280. That will give us 7,240. 7,240. Then you now sum up the total equity of 19,340 plus the total of non-current liabilities of 5,280 plus the total of current liabilities of 7,240. The total will be 31,860. That is the total equity and liability. Total equity and liabilities. That is the end of the solution to the question. Please, if you have not subscribed, please, if you have not subscribed in the past, remember subscription is just once and for all. If you have not subscribed in the past, please hit the red subscribe button so that you'll be able to receive notification each time I drop any video in the future. Thanks.